Welcome back to America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates with Nolan Baker and Dave Ross. ARHQ.com is the website. You want to find out more about the team, including the Retirement Team Action Plan, the Independent Income System. You can go to the website. You can also give a call, 419-794-3030. One of the signs that we are headed for a recession is something that's called the inverted yield curve, which happens when you get paid more for a short-term bond than a long-term bond. But analyst Ed Yardini tells Yahoo Finance he doesn't think it's going to happen this time because, the Federal Reserve acted properly.
And this notion that an inverted yield curve means that we're going to have a recession, what it really does is it predicts a process. It predicts a process that if the Fed continues to raise interest rates, something will break in the system, and that will lead to a credit crunch. And it's credit crunches that cause recessions. Well, the yield curve got it absolutely right again. And we did have a financial crisis last year, but the Fed came in and played whack-a-mole. That they whacked it right down with the liquidity facility, and we didn't get a credit crunch, so we didn't get a recession.
I don't want to get too into the weeds here, but I can't help but feel like this sounds like something else that we can't control. What we can do, though, is prepare. What are you guys telling clients right now?
Well, the term of a recession, it seems to me it's been going on for 4 years now, right? I mean, we've been talking about recessions on this show for multiple years now. Like, are we coming into a recession? Are we in a recession? And what is the definition of a recession, right? They even changed that. But it really doesn't change the belief and the philosophy that we have here at America's Retirement Headquarters. If you go and you Google the independent income system, it really kind of gives you the belief and the philosophy that we have. And with that being said, I think there are a couple things when we look at 2024. Number one, cash can be king, right? We have cash accounts currently now with money market accounts. They're the highest that I have seen since my children have been alive. So, for those investors that are looking at FDIC insured CDs or cash or money market accounts, there's some great rates that are out there. And with inflation, the numbers where they're at, it may be a little bit longer before the Federal Reserve actually has the ability to cut interest rates. Bonds, we talked about on the show, prior to interest rates going up, the interest rate risk in the bond fund market. But at some point, when interest rates go down, bonds become, more attractive. We have now the stock market is close to or at an all-time record high, depending upon, what index that you look at. Bonds haven't really fully recovered. Even this year, bonds are still down a little bit. So at some point, that becomes attractive. We talk about in some of our methodology when we look at the 5 key principles of what we like in investments. So cash rich, low debt, high profit, companies that have a competitive advantage and or are needed on a daily basis. These typically tend to be more defensive stocks. So again, whether we have a recession or not, I can pretty much guarantee you that my son's going to get up. He's going to have cereal for breakfast, and I'm going to, he's going to spill stuff. I'm going to get up, clean the kitchen counter. I can pretty much guarantee you after we get back from a trip, we're going out of town here in the next week, my wife's going to be like, I'm going to the grocery store next week. What do you want? I mean, she's going to go to the grocery store regardless of whether we're in a recession or not. Now, maybe she'll be more conscious about what she purchases, but again, grocery stores, those type of companies tend to be more defensive. I'm going to have a Coca-Cola. I'm going to have a Diet Coke, or, I'm going to go out to the golf course and, do the things that I'm used to doing. So defensive stocks. Now, Dave, in an earlier segment, you had talked a little bit about dividend paying stocks. That's another area that's great. So if you have a basket of investments of companies that pay dividends, and if you're blessed enough to be able to just live off of those dividend paying stocks, the daily price of what that stock is becomes less relevant if you can just live off of those dividend checks that come into the portfolio. And then in addition to that, what you have to be careful about is, I would say you got to be careful about major changes. So one of the worst things that I think I can ever hear an investor say is, this time it's different. And it could be about the election. It could be about a recession. It could be about a war. It could be about whatever the case happens to be, but sometimes you hear people say, well, this time it's different. And so what they want to do is they want to take their portfolio and completely shift and change the way they're allocated. Now, that could mean taking all of the money out of those quality stocks that they identified. That could mean putting all of their money into precious metals. And I'm not saying there's anything wrong. Gold and precious metals have historically been an area that is something that maybe you would invest in before a recession, but those type of things or alternative investments doesn't change the overall game plan. So this is probably a common question that you have clients that are asking you about as well, as far as investing in a recession. And what I would say is, again, this time it's not different. This time it's going to be the same as it's been in the past. Use history as a guideline to make a smart decision going forward, and that'll be the best thing to help you with making your informed investment decision.
The one thing that may be different this time is that you're closer to retirement, perhaps even getting ready to retire. And so a market downturn, a recession, if and when it does happen, could be devastating if you don't have a proper plan in place. The good news is there's still time to put that plan together, but you got to pick up the phone, take that first step, reach out to the team at America's Retirement Headquarters, 419-794-3030, or the website, always available day and night at arhq.com.